My name is Jake, welcome to the channel. In today's video, we're gonna do a deep dive into one of the best high dividend ETFs out there in SCHD. This is one of my favorite high dividend ETFs that I own in my portfolio. I get asked often, Jake, what is your favorite ETF out there? Or if you could only invest into one ETF, what would that be? Well, apart from the broader stock market, maybe in VTI, my favorite high dividend ETF is SCHD. This ETF is one of my largest ETF holdings in my portfolio, and I've held this for roughly about, ever since I set up the portfolio. It is equally weighted with VYM. If you've been following my channel, you know a couple of months ago, I shared an entire video on VYM, but in this video, we're gonna just focus on SCHD. In this video, we're gonna cover 5 topics. We're gonna do a deep dive into SCHD. I'm gonna walk you through exactly what you're getting when you invest into SCHD and what that means. Second, we're gonna dive into the Dow Jones US Dividend 100 Index. So every ETF follows a specific index. SCHD follows the Dow Jones US Dividend 100 Index, and I'm going to walk you all through what that exactly means. And then what we're going to do is we're going to compare SCHD to VYM. Not only historical performance, but specifically the fund overlap, what you're getting in each individual fund, and how those two compare, and why it could make sense to hold one or the other or both. And then we're going to compare SCHD to the S&P 500 and what the historical performance would have been if you would have invested since its inception. And we're going to look at the total return, so with the dividend reinvested. And then lastly, we're going to plug SCHD in to a dividend compound reinvestment calculator, and we're going to see what the projected returns could look like potentially in the future over a 10, 20, and 30-year time horizon, and who should maybe potentially look to investing into SCHD depending on your time horizon. SCHD has been one of the highest performing high dividend ETFs out there, and I'm sure a lot of you that are watching this video are already currently invested into SCHD, and I'm sure there's a lot of you that are maybe considering it. But for everybody out there that is invested into SCHD, you're probably feeling pretty good. You're probably feeling it a little like this.
Put it fifth, dude. Put it fifth. Tally ho, dude. Woo! Put it fifth. I am it fifth.
Oh my gosh, could you imagine being the guy in the middle on that motorcycle? Oh man, good times. All right, so the Schwab SCHD ETF, it has, first off, the most important thing, when I'm looking at ETFs, I want to make sure that I'm not overpaying for the ETF. And in order to do that, I'm looking at the expense ratio. SCHD has a very, very low expense ratio. This is important because the expense ratio eats at your total returns over time. So when looking at the fund's goal or objective, it's to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. Now, the next segment here in this video, we're going to take a deep dive into what that exactly is, because it's really important that you understand how the Dow Jones US Dividend 100 Index is set up and the methodology behind it, because essentially you're getting the exact performance of that index. And so it's truly important that you understand that. So the highlights of this ETF is it's a straightforward, low-cost fund offering potential tax efficiency, but also the fund can serve as part of the core or complement in a diversified portfolio. So this is what I was talking about. If I were to just own SCHD as a whole or add it or supplement my portfolio with it, me personally, I would not just YOLO all into SCHD. I wouldn't necessarily be Jen in this situation, but rather I would have it complement or, be part of my overall portfolio. I would even consider, if I was building my portfolio new, building my dividend portfolio around SCHD, I think could be a really good idea. Another highlight is it tracks an index focused on quality and sustainability of the dividend. If you're a dividend investor, you want to make sure that your dividends are coming in both good times and bad times. Right? And so especially if you're quitting your job, you're looking to retire early or be financially independent off of your dividend portfolio, quality and sustainability are so important when it comes to constructing a dividend portfolio. SCHD has not been around for all that long. It's only been around for about 10 years. Its inception was here towards the end of 2011. It has, 28 billion in assets under management, which is a good amount. And then when you look at the total holdings, currently there's 95 holdings. And I've noticed that this number kind of varies depending on which website that I use. So I use ETF.com. This is on the Schwab's, website themselves. So I try to take everything with a grain of salt when I research ETFs on different websites. Here on the Schwab site, it's saying that they have 95 holdings. And this, once again, because it tracks the index, the Dow Jones Dividend 100 index, which holds 100 companies. So it tries to track it as closely as possible. And also important to note, this is a passive index, so it's not a actively managed ETF. It currently yields right around 3%. When looking at the performance over the last year, 3 years, 10 years, and since its inception, it's done very well. This year, the fund is up about 50% for over the last year. This is not year to date. This is over the last year, 12 months. The last 3 years, it's up about 20%, or annualized rate of return has been 20%. 5 years, about 15%. And since its inception, a little over 15.5%. This is absolutely incredible. So to take a look at all of their holdings, we're going to head over to ETF.com. And if you type in the ticker SCHD and you scroll all the way to the bottom, you can see the individual holdings based off of their weighting. So you can see that no one individual company is weighted over 5%. I really, really like that because it really is a great way to reduce and manage risk. And so if we want to view all of these companies, we can see that Pfizer is the largest weighted at just over 4.5%. And if we scroll down, we can see that the majority of them, the weighting drops off, but the long tail is not as great as with other ETFs. You can see if you're invested in, Kellogg's here, right? You're getting 0.5%. This is still a decent percent to be invested into Kellogg with this ETF. And that's what I like about this. This ETF does not have a longer, when looking at the long tail or the lower percentage of these other holdings, you're still a shareholder in these companies. When you look at some of these other ETFs, you might have 0.003% into a company, and you don't really feel like you're invested into that company. But with SCHD, because there's only 95 holdings, you're getting good exposure to all of these companies in this ETF. This is something that I personally really like. So now let's take a look at the Dow Jones US Dividend 100 Index and what that exactly is. So if you invest into SCHD, SCHD follows the Dow Jones US Dividend 100 Index, so you're getting one for the most part. So the Dow Jones US Dividend 100 Index is designed to measure the performance of high dividend yielding stocks in the US with a record of consistently paying dividends selected for fundamental strength relative to their peers based on financial ratios. And because this is a market cap weighted index, it really is the survival of the fittest. It's not an actively managed ETF or index, and that's something that I really like about this. This is similar to the S&P 500. It's similar to the total US stock market index, right? It's self-cleansing. When a company is doing well, they represent a higher percentage in this index. When a company is not doing well, they represent a lower percentage or a lower weighting in this index. And so we talked about sustainability and risk. This is something that I love about ETF or index investing is it's self-cleansing, and you as the investor don't have to do anything. The market dictates the index. And that's something that I really, really like as an ETF investor. So when looking at the sector breakdown, over 20% is in financials, under 20% is in industrials, just over 16% is in technology and also in consumer goods. Then healthcare is a little bit lower than consumer services, telecom, basic materials, and oil and gas is just over 1.5%. There's no sector over 25%, which is really a great way to minimize risk and volatility when you're investing in this for the long term. Now, it's important to understand the sector weighting. It's important to understand what the largest holdings in this ETF are today, but it's even more important to understand the strategy of this index so that you as a long-term investor understand how this ETF is going to change over time. And so this index, the Dow Jones Dividend 100 Index, is focused on a few things. First, it's focused on the sustainability of the dividend and the financial quality of the companies in this index. So doing so, they seek to achieve quality yields by requiring stocks to have paid dividends for a minimum of 10 consecutive years, and by ranking stocks by a composite score calculated from the cash flow to total debt ratio, the return of equity, the dividend yield, and a 5-year dividend growth rate. These are the metrics that are used to calculate companies, which stocks are held in this index. There's also a focus on the dividend growth against future rising rates. So interest rates are also a factor when looking at which companies are going to be held in this index. And then lastly, the investability of these companies, the size of the companies, the market cap of these companies is also a factor. Now, when looking at the methodology here on this table, I want to focus on 3 sections. I want to focus on the eligibility screening, the weighting, and the rebalancing. First, the eligibility rating, it's focusing on that 10 years of consecutive dividend payments. It's focusing on a market capitalization of at least 500 million and an average daily volume of trades of at least 2 million. So these are large blue chip companies, large established companies that are held in this index. Then when looking at the weighting, this is really, really important. This is what I talk about a lot on my channel, is that stocks are weighted by market capitalization and they are subject to a 4% individual stock weighting cap and a sector weighting cap of 25% and 15% for international markets. So 4%. So you notice that Pfizer was just at 4.5%. So not a single company in this index can get over a 5% weighting. I really like this because it reduces your risk. And also when talking about the sector weighting, not one single sector will be over 25%. I really, really like this. And then lastly, the rebalancing here. This happens on an annual basis here in March. And lastly, taking a look at the index's performance over the last 20 years, it's really interesting to see how this index, the Dow Jones US Dividend 100 Index, has compared to the Dow Jones US Broad Stock Market Index during market corrections. So during the tech bubble, this index, this ETF did not exist, right? But the index existed. So very important, don't get confused. The index was up during the tech bubble, whereas the broader US Dow Jones Stock Market Index was down 44%. And then if you look at the financial crisis of 07 to 09, this index was down 44%, whereas the broad index was down over 50%. And if you look at the crisis in Europe, during 2010, this performed better during that time period. And then lastly, when comparing the pandemic performance here in 2020, the two indices here performed fairly similarly. Now let's take a look and let's see how SCHD compares against VYM. When looking at the expense ratio, they both have the exact same expense ratio. SCHD has slightly less in assets under management, but not really a big deal. The index for SCHD is the Dow Jones US Dividend 100 Index, whereas VYM is the Financial Times Stock Exchange High Dividend Yield Index. You can see here that it has 102. Once again, on different websites, I'm seeing different amounts of holdings. So roughly about 100 holdings, whereas VYM has over 400 holdings. When looking at the performance, SCHD has outperformed VYM from what I can tell almost every time period. And if you look at the 10-year is just over 15%. This chart is not updated, but it is about 15.5% for SCHD, so outperforming VYM. When looking at the sector weighting, you can see that they're both largest is in financials. SCHD has more exposure to technology. And so you can see that energy is the lowest on SCHD, whereas VYM has a little bit more to energy. When looking at the largest holdings, the largest holding of SCHD, Pfizer, Cisco, BlackRock, whereas with VYM, JP Morgan, Johnson & Johnson, and Home Depot. So there will be some overlap between the both of them. When looking at the overlap, comparing SCHD to VYM, 89% of SCHD's 101 holdings are also in VYM, whereas just under 22% of VYM's 412 holdings are also in SCHD. You can see, yes, the large majority of SCHD's holdings are also in VYM, but the percentage allocation of how they're allocated is very minimal. So if you were to invest into both of them, you're actually not getting as much overlap as you would think in terms of the weighting of the individual holdings. So in my opinion, when looking at this, I could see reasonably why an investor would hold both VYM and SCHD in their portfolio and not just trying to decide one or the other, because they are very, very different. Now let's take a look and see how SCHD has compared to the S&P 500 with the total return in mind. The total return is with the dividend reinvested. Year to date, SCHD is slightly outpacing the S&P 500. Over the last year, SCHD has outperformed the S&P 500, but when looking at 3 years, the S&P 500 has slightly outperformed SCHD. And then with a 5-year historical chart here, you can see that the S&P 500 is outpacing SCHD. So when you're comparing the two, it really depends on the time period in which you're comparing. Now, if we were to go all the way back since the inception of SCHD back at the end of 2011, if we were to look at the historical performance of the S&P 500, we can see that we've gotten an annualized rate of return of just over 16%, so almost 16.5%. When comparing that with SCHD, you can see that SCHD, since its inception, has had an annualized rate of return of 15.5%. So just lagging the S&P 500 by 1%. In my opinion, as a dividend-focused investor, I believe that this is a very, very strong, high-performing ETF with comparable long-term results with the S&P 500. Lastly here, I want to take a look at what the future potential returns could look like if you were to invest into an ETF like SCHD. We're going to use historical performance here. We know that historical performance is no guarantee of future performance, but in order to calculate future returns, we're going to look at the past to help us tell a story for what the future could potentially look like. This dividend reinvestment calculator is a spreadsheet that I put together that you can use for free. I will link it in the pinned comment below. You can make a copy of it to edit it, and all you have to do is focus on the yellow fields here. If you update the yellow fields, the entire chart here and the graph to the right will update automatically. So what we're going to do is we're going to assume that today you were to invest $10,000 into SCHD. And we're going to assume going forward, every month you're going to invest an additional $1,000. If you're not able to invest $1,000, okay, that's fine. You could update that to $500. Or if you're able to invest more, you can update it so that it meets your particular goals. For the purpose of this video, I'm going to keep it straightforward and say that we're going to invest $1,000 a month. And we're going to look at that over a period of time. We're going to assume that that 15.5% annualized rate of return is going to continue. Who knows if it does, but we're going to use that number. So for the capital appreciation, we're going to focus on 12.5%. And the dividend growth rate, which I got from seekingalpha.com, is right around 12%. The current yield is around 3%. I took the 4-year average of the dividend yield, and it gave me just under 3%. So that's how I got the numbers there. In the spreadsheet here, you can see in the bottom here how you can get these numbers and calculate these numbers for yourself if you would like. So I know that there's a lot of numbers here on the screen. There's a few things that I want you to focus on. If we were to look after 10 years, the portfolio would be valued at just under 300. Now, there's a few things that I want you to take a look at. So the first thing is this end of year portfolio value. After 10 years, you'd have just under 300,000, but you would have invested $130,000. So what would that look like if you were to continue in reinvesting and adding to your portfolio for 20 years? In 20 years, your portfolio would be valued just under $1.5 million. And here's the cool thing. After 20 years, you would have only invested $250,000. So this is assuming that you don't get a raise at your job. This is assuming that you don't cut your expenses. This is assuming that you only are investing that $1,000 every single month. And this is pretty cool. In 20 years, this is what the portfolio would look like. Now, if you were to do this for 30 years, if you were to reinvest the dividend and add $1,000 a month for 30 years, we can reasonably project that in 30 years, your portfolio would be valued over $6 million. And the magical thing about compound interest is your investment. You would have only invested $370,000 in this portfolio. But the growth of your portfolio, this is the remarkable thing about dividend growth investing. This is the magic of compound interest. This part right here, this dividend growth, the capital appreciation growth, this is what is so powerful when investing into an ETF like SCHD, is you're getting that massive growth. So that was looking at the share price of the portfolio. Now let's take a look at the dividends over time. What would the dividend income look like if you were reinvesting the dividend that entire time and adding that $1,000 every single month? Well, in 5 years, if you never sold a share and you followed this path for 5 years, you would get just under $3,000 in annual dividend income. Okay, that's not bad, but what if you did that for 10 years? In 10 years, you would get $8,000 in annual dividend income. And if you were to continue to do this for 20 years, never adding more than $1,000 a month, you can reasonably project that you would have $38,000 in annual dividend income in 20 years. And this is where it really, really gets exciting. In 30 years, if you were to continue to do this for 30 years, you can reasonably project that you would be getting over $150,000 in annual dividend income. This is absolutely remarkable. This is the power of compound interest. By leveraging this dividend reinvestment calculator, you can reasonably project what the growth of your portfolio would look like and the growth of the dividend income over time. If you're in your early 20s, or if you're just starting to invest and you have 30 years to invest before you're looking to retire, this is something that you really, really want to understand, because this is the magic of compound interest. And once again, this is assuming that you're not adding more than $1,000 for 30 years. This is not taking into consideration that you're getting raises at your job or you're investing more money throughout these 30 years. $156,000 in 30 years is a lot of money. But one thing that you do have to factor in is that silent killer being inflation. Your purchasing power today with $156,000 will look very different in 30 years. So that is something to really be mindful of when you're projecting this and looking into the future. But it is so important that you understand the power of compound interest, and that your returns over a longer period of time will grow exponentially the longer that you're investing. And investing into a high quality dividend growth ETF like SCHD is a great way to maximize your returns and grow your net worth and your portfolio over the long term. SCHD is a great investment if you have a 5-year time horizon, a 10-year time horizon, or a 30-year time horizon. Once again, I mentioned earlier in the video that SCHD can complement your overall portfolio. Based on your time horizon, you can set up the weighting of SCHD in your portfolio so that it meets your goals. The weighting in a 20-year-old with a 30-year time horizon may look different than somebody that is maybe in their 50s looking to retire in the next coming years. But I believe that SCHD is a high-quality dividend growth ETF that every dividend growth investor should consider adding to their portfolio. Thank you so much for watching, everybody. I hope that this was helpful. I hope that you learned something new, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.